Hi everyone, I am Dr.R. Devi Prasanna, Assistant Professor, School of Management, Kristu Jayanti College, Bengaluru. In this video lecture, we are going to learn cash flow statement. There are three main financial statements: income statement, balance sheet, and cash flow statement. Income statement reveals revenue and profits. Balance sheet shows a snapshot of financial position, and cash flow statement depicts the cash inflow and outflow. Cash flow statement applicability. As per Accounting Standard 3, it is mandatory that all the companies have to prepare the cash flow statement except small and medium scale business, and in case of non-corporate entities, level 2 and level 3 companies. As per Companies Act 2013, cash flow statements must be prepared by all the companies except dormant companies, private companies, one-person company, private company, especially startup companies and small companies. As per SEBI, all the listed companies has to prepare cash flow statement under indirect method. Cash flow statement is nothing but a statement of cash flows. A cash flow statement is a financial report that summarizes the cash inflows and outflows over a specific period. It provides insights into a company's liquidity and overall financial health by detailing how cash is generated and used in operating, investing, and financing activities. We can divide cash flow statement as cash flow statement. Cash denotes cash and cash equivalents. Cash equivalents includes bank, current investment, marketable securities. Flow is nothing but changes, may be positive or negative. Statement refers to the summary. Therefore, cash flow statement is a summary of changes in cash and cash equivalents. Company prepares cash flow statement and is used by different users in order to know how a company uses and generates cash, future requirements of cash, ability to generate cash, and liquidity and solvency assessments. Company needs cash to operate, to pay its obligations, to provide return to investors, and to expand and grow. How to prepare a cash flow statement? We can prepare a cash flow statement under two methods: direct method and indirect method, as per Accounting Standard 3. We can classify cash flow under three heads of activities. They are operating activities, investing activities, and financing activities. Operating activities are nothing but the normal business operations. Investing activities are nothing but purchase of fixed assets and non-current investments. Financing activities includes issue of shares and mobilizing loans, etc. In the normal business operations, we have inflow and outflow of cash. Inflow includes sales, royalty received, commission received, cash received from debtors. Outflow includes salaries, wages paid, income tax paid, cash purchases, payment made to creditors, etc. In the investing activities, again, we have inflow and outflow of cash. Inflow includes sale of assets, sale of non-current investments, interest received, dividend received, and outflow includes purchase of assets, purchase of non-current investments. In the financing activities, again we have inflow and outflow of cash. Inflow includes issue of shares, issue of debentures, whereas outflow includes interest paid, dividend paid, redemption of debentures, buyback of shares. Cash flow statement is crucial because cash is the lifeblood of business. Without a steady stream of cash, companies can go out of business. Thus, cash flow statement is how cash is generated and used in operating, investing, and financing activities. Cash from operating activities includes the amount of cash left over after all the cash income and expenses for the core operations are received and paid. Investing activities includes cash used to buy and sell investments and long-term assets such as capital expenditure. Financing activities includes cash flow to and from owners, investors, creditors. To sum up, the cash flow statement gives us a picture of the true cash position of the company. A legitimate company has three main activities: operating activities, investing activities, and financing activities. Each activity either generates or drains money for the company. The company's net cash flow is the sum of operating activities, investing activities, and financing activities. Investors should specifically look at the cash flow from operating activities of the company. When the liability increases, cash level increases and vice versa. When the asset increases, cash level decreases and vice versa. The statement of cash flow is a useful addition to a company's financial statement because it indicates the company's performance. Thanks for watching.